74 million ounces of silver were delivered through COMEX in January and February of 2026. 74 million ounces. That is the highest delivery volume recorded in modern COMEX history. More physical silver demanded for actual delivery in just 2 months than most previous full years of COMEX delivery activity. Record COMEX silver deliveries, prices refusing to break higher. If you have been asking why silver price is not exploding despite the most dramatic physical delivery activity in COMEX history, today we answer that completely. With data, with the actual delivery numbers, without drama. This is your record COMEX delivery complete breakdown. What 74 million ounces of deliveries actually means, why prices are refusing to break despite this historic physical demand, and exactly what happens next when delivery volume at this scale collides with registered inventory at 86% depletion. My name is Stack AG. We invest with logic, not hype. Let us get into the data. Before we explain why prices are not breaking, we need to establish exactly what 74 million ounces of COMEX deliveries actually represents, because this number requires context to understand its full significance. A COMEX silver futures delivery occurs when a contract holder, instead of closing their position before expiration, stands for physical delivery. They want the actual silver, not cash settlement, not a rolled forward position. The physical metal delivered to a COMEX approved vault in their name. In normal market conditions, the vast majority of COMEX silver futures contracts are closed or rolled before expiration. Physical delivery is the exception. Most paper traders never intend to take delivery. They are trading price exposure, not accumulating silver. When delivery volume spikes, it means an unusually large number of contract holders are choosing physical silver over paper settlement. They are converting paper claims into physical metal, removing silver from the registered inventory system permanently, or at minimum transferring it from registered to their own allocated account. 74 million ounces in 2 months represents a fundamental shift in market behavior. This is not retail investors buying silver coins. This is institutional scale physical silver accumulation happening through the COMEX delivery mechanism. Entities large enough to hold and take delivery of COMEX contracts, measured in 5,000 ounce lots, deciding they want physical silver rather than paper exposure. The scale is unprecedented, and it is happening at the same time that registered silver inventory has been depleted by 86%. Creating a collision between record physical demand and near record low physical supply that the paper spot price has not yet reflected. Understanding who is taking delivery at this scale, and why, is the key to understanding what this historic delivery volume signals for silver price going forward. 3 categories of delivery takers are driving the 74 million ounce figure. Category 1, industrial manufacturers securing supply directly. Solar panel manufacturers, EV battery producers, semiconductor fabricators. As traditional silver supply chains show stress, extended delivery times, rising premiums from wholesale distributors, major industrial consumers are increasingly going directly to COMEX to take physical delivery at spot price, bypassing intermediaries, securing supply directly from the exchange vault system. When industrial buyers take delivery through COMEX, that silver goes to factory floor. It gets consumed in manufacturing. It does not return to the vault. It is permanently removed from the registered inventory system. Industrial delivery taking at COMEX scale is the most bullish possible physical demand signal because it represents guaranteed consumption, not investment holding that could be returned to the market later. Category 2, institutional investors converting paper to physical. Sophisticated institutional investors, family offices, commodity-focused funds, precious metal specialists have been converting paper silver exposure to physical allocated silver. The 4 COMEX warnings we covered in our previous video, 86% inventory depletion, extreme paper to physical ratios, rising lease rates, crowded positioning, are driving institutional decisions to hold physical rather than paper. When institutions take COMEX delivery, they are expressing a specific view that physical silver in their direct possession is worth more than a paper claim on silver through a futures contract. That the counterparty risk and delivery risk embedded in paper silver is now worth eliminating through physical possession. Category 3, arbitrage traders capturing SGE premium. As we covered in our Shanghai premium video, the SGE silver price has been consistently above COMEX silver price. Traders taking COMEX delivery and shipping silver to Shanghai capture the spread between Western paper price and Asian physical premium. At 74 million ounces of delivery volume, this arbitrage mechanism is operating at a scale that is draining COMEX vaults and simultaneously supplying Asian physical demand. 3 delivery categories, all removing silver from COMEX registered inventory, all structural rather than temporary, all contributing to the unprecedented delivery volume that the spot price has not yet reflected. Here's the mathematical reality of what 74 million ounces of COMEX deliveries means in the context of current registered inventory levels. COMEX registered silver inventory currently stands at approximately 21 million ounces. We have covered this extensively. It represents 86% depletion from peak levels. 74 million ounces of deliveries in 2 months, against 21 million ounces of current registered inventory. The deliveries did not all come from current registered inventory simultaneously. They occurred across multiple contract months over the 2-month period. Each delivery period drew from the registered inventory of that specific period, with some replenishment from eligible conversions occurring between delivery periods, but the ratio tells a critical story. The annualized delivery pace implied by 74 million ounces in 2 months is 444 million ounces per year, against current registered inventory of 21 million ounces. The registered inventory at current levels could theoretically satisfy less than 3 weeks of deliveries at the current annualized pace. Without any replenishment from eligible conversions or new physical supply entering the system, this is the mathematical collision that the paper spot price has not yet processed. Record delivery demand, near record low registered supply. A ratio between the two that is geometrically unsustainable at current price levels. The only mechanism that resolves this mathematical collision sustainably is price. Higher silver prices attract new physical supply into the registered inventory. Higher prices make eligible silver holders willing to convert to registered status. Higher prices slow industrial delivery taking as manufacturers reassess supply chain alternatives. Price is the market's only tool for balancing record delivery demand against near depleted registered supply. And that price adjustment has not yet happened at the scale the math demands. Now, the central question. If 74 million ounces of physical silver were delivered through COMEX in just 2 months, why are prices refusing to break dramatically higher? Same answer. Same mechanism, same paper market dominance, we have identified consistently across our entire video series. Silver spot price is set by the total COMEX futures market, not just by the delivery portion of that market. And the total COMEX futures market is vastly larger than the delivery portion. Total COMEX silver open interest represents approximately 800 million ounces of paper silver exposure. 74 million ounces of physical deliveries, while historically unprecedented, represents less than 10% of total paper market exposure. The 90% of paper traders who are not taking delivery are still setting the marginal price through their buying and selling of futures contracts. And those traders are responding to dollar movements, Federal Reserve language. Equity market risk sentiment, short-term technical chart levels. They are not watching delivery volume statistics. They are not calculating the ratio of delivery pace to registered inventory levels. They are watching Bloomberg terminals for the next macroeconomic data release. So record delivery volume can occur, removing physical silver from the system at unprecedented pace, while the paper market price refuses to break higher. Because the paper market is 10 times larger than the physical delivery market. And the paper market does not yet feel the pressure that the physical delivery market is creating. The word yet is the most important word in that sentence. Because eventually, as registered inventory continues depleting toward critical levels, the paper market will feel that pressure. And when it does, the price response will reflect not just current delivery pressure, but months of accumulated physical deficit. Here is the specific calculation that tells us how close the breaking point actually is. Current registered silver inventory, 21 million ounces. Current annualized delivery pace, 444 million ounces. At current delivery pace with zero replenishment, registered inventory exhaustion occurs in approximately 17 days of delivery activity. Obviously, replenishment occurs between delivery periods through eligible to registered conversions. The question is whether replenishment can keep pace with delivery demand at current price levels. Historical data shows that eligible to registered conversions accelerate when registered inventory falls below approximately 15 million ounces. Below that threshold, the scarcity signal becomes strong enough that eligible silver holders begin seeing conversion value at current prices. We are currently at 21 million ounces, 6 million ounces above the historical conversion acceleration threshold. At current delivery rates, that 6 million ounce buffer is measured in weeks of delivery activity, not months, weeks. When registered inventory falls below 15 million ounces, 2 things happen simultaneously. Conversion acceleration begins, temporarily slowing the drain, and paper market traders begin noticing inventory levels in their risk models, creating upward price pressure from the paper side for the first time. That dual pressure point, conversion acceleration plus paper market recognition, is historically where silver price begins moving in a way that reflects physical delivery reality. And the math says we are weeks away from that threshold, not months. Here is how record COMEX deliveries connect to every other data point we have been tracking on this channel. 74 million ounces of physical deliveries in 2 months, draining registered inventory toward critical levels. COMEX registered silver 86% exhausted, only 21 million ounces remaining. Shanghai Gold Exchange paying premiums above COMEX spot. Arbitrage flows accelerating physical silver movement from west to east. Retail silver selling out. Individual investors paying elevated premiums and waiting weeks for delivery. Solar silver demand grown 400% in 5 years. Government mandates driving consumption mine supply cannot match. Industrial demand across solar, EV, and semiconductor sectors at record levels and growing. Central banks buying gold at record levels, driving gold-silver ratio to historically extreme levels that mathematically imply dramatic silver catch-up. 7 independent data points, 7 separate layers of the silver market, all simultaneously pointing to the same conclusion. Physical silver supply is severely constrained at every level. Paper price has not reflected this constraint. The mathematical collision between record delivery demand and near-depleted registered inventory is bringing the moment of reflection measurably closer every single week. The record 74 million ounce delivery volume is not an isolated data point. It is the physical market's most direct and forceful expression of the same structural reality that every other data point in our series has been signaling. This is not financial advice. Always consult a qualified financial professional before making investment decisions. The record COMEX delivery data has direct practical implications for silver investors at every level. If you hold physical silver, the delivery volume data is the strongest possible validation of your thesis. Entities large enough to hold COMEX contracts and take 5,000 ounce lot deliveries are doing exactly what you have done, converting paper exposure to physical reality at unprecedented scale. You are on the same side of this trade as institutional delivery takers. If you hold paper silver through ETFs, understand what the delivery volume data means for your position. The physical silver market is tightening dramatically. But your ETF position gives you price exposure, not physical silver. In a scenario where physical delivery stress creates a premium between physical prices and paper prices, ETF holders may not fully capture the physical silver price move. If you are considering entering the silver market, the record delivery volume removes one of the most common objections to silver investment at current prices. The objection that paper price reflects true value. When institutional entities are taking physical delivery at record pace, at current prices, they're telling you with their capital that current paper prices understate physical value. Subscribe. Hit the bell. Share this with one silver investor who does not understand what record COMEX delivery volume actually means for price. I am Stack AG. Invest with logic, not hype. See you tomorrow.